Today we'll be talking about investors calling the Fed's bluff. First of all, I want to apologize for lack of upload. I haven't found much motivation lately. And also, the last video, I originally named it Fed signaling tightening, but that was actually incorrect. It was more so the Fed increased rates on certain savings program like the overnight repo market, and investors are choosing to put money in those programs instead of letting it be in the market. And now the repo market is over $1 trillion. And so what the Fed is doing is what's causing investors to pull liquidity out of the market. And I've since changed the title. Now, first off, executive summary. So we'll talk about U.S. economic data and how the focus for U.S. is benefiting in the present at the cost of future by bringing future demand forward to the present by going into debt, buying a lot more now, so pretty much just loading up on your credit card. Next, we'll talk about Fed's continued narrative, inflation being transitory, it won't be a concern, and trying to not talk about tapering as much as possible, and they still can't tell the truth about inflation and why, if they're seeing the economy being so good, why can't they shrink the balance sheet and start tapering? And then we'll talk about the U.S. equity bubble, mainly being tech stocks, pushed up a valuation by lower and lower real yields. And then we'll talk about the emerging markets, deleveraging, how these emerging markets are learning from history by deleveraging now, not allowing U.S. Liquidity to prop up their asset bubbles, and then by U.S. deleveraging first, they pop the asset bubbles in elsewhere. And finally, we'll end with a commodities update. These are the topics we'll be going over today. Again, I'm not a licensed financial advisor. Please conduct your own research. These are only my personal opinions. Let's take a look at some of the U.S. economic reports that came out recently. First off, with CPI report, continues to make big step on year-over-year basis, based on the artificially low basis, Powell is calling it base effects, meaning last year it was a very low amount because everything was shut down and no one was going out spending as much, and that's why it was a lot lower. So that's why with more much higher prices this year from more people coming out and spending, then CPI will look a lot higher than it otherwise would be. So that part was reasonable, but I think the focus going forward and also looking at it should be the month-over-month amount. So don't look too much at year-over-year, but rather month-over-month. So yes, last year was maybe artificially low, but if we continue to make big month-over-month amount, then the idea that inflation is transitory or there's no inflation is definitely something to be concerned about. Next up, inventory cycle. So consumer spending has been abnormal for the first half of the year. There's been a lot of consumer spending, and we can see that from later on in GDP report. And going forward, we might see inventory levels continue to build from the lack of demand. So what's really happening is a lot of people are able to buy up a lot of stuff from all the stimulus checks, but if that is not to continue, then they're also going into a lot of debt to buy a lot more stuff than otherwise. So I think this Christmas would be a bad sales time for a lot of the retailers. Now looking at GDP, so the latest GDP for the month is looking at 6.5%. It's missing expectation of 8.5%, with the GDP deflator, meaning the difference between nominal and real, at I think it was 6.4%. So meaning nominal GDP growth, obviously annualized, it was at 12%, but 6% of that was due to inflation. So again, going back to the idea that like, oh, some people still think that there's no inflation. So that's a big part. But if we actually dive into the GDP number, we can see that there was a 7.8% of it, the increase was from consumer spending. Well, if it's 7.8%, how is the GDP, the headline number is 6.5? Is because there's actually a drop in investing in government spending, and also net export, meaning there's more import than export. And again, we go back to the idea that we're really benefiting in the short term by pulling future consumption and demand to today. So it's propping up these financial asset prices because earnings look good, but there's actually no improvement of the underlying productivity of the economy. So that's going to be an issue going forward. Now let's take a look at the Fed stance. Now again, their stance is that inflation is still transitory, but Powell did come out and say that he do expect that inflation could be higher before the whole transitory phase is over. So there's currently no rate hike yet and no tapering, and he's continually to try to avoid talks of it. And someone did ask, because real estate has been red hot recently and over the past year, that if he would slow down mortgage-backed securities buying before general pullback on tapering on U.S. Treasuries, and he said they would be done at the same pace. And another thing that I found from the reports is that they've actually been buying a lot of the TIPS market, the inflation protected treasuries, and it's actually painting an artificially low picture for the real rates for both 5-year and 10-year. And the takeaway is that if they're pushing down real rates, because when they're buying TIPS, it pushed down the rates. Same with regular treasuries. It's giving the illusion that real rates are going lower. Maybe it is. But because they are buying more of it, so they do have an impact pushing real rates lower, which impacts valuation. And maybe this is something they're doing to try to help boost valuation by pushing real rates lower. So when people are seeing like, okay, real rates are lower, and I'm discounting financial assets, and especially for growth oriented investments, because there's no consistent cash flow, then a lower discount rate has more impact on today's valuation versus something that has a steady cash flow. And on the inflation being transitory side, based on the CPI report recently, so used cars and energy has been, other than real estate, has been a big factor on the CPI increase. And with the microchips shortage not being such a big issue now because the supply has picked up, and also shipping has been more reopened now, I don't expect used car prices to continue to climb. And with energy, I don't expect it to rise at the pace that it has been. However, I do expect it to to increase, but not at the pace that it has been increasing. So the only real pushing factor could be real estate. That's something that we need to continue to watch. Now let's take a look at the Biden infrastructure plan. So the latest news is that the Senate is expected to get enough Republicans to sign on, which is 10, because the Democrats controls 50 seats, and there's only one exemption each year for a 50 vote majority to pass a bill, and that was already used for the first stimulus check by Biden. That I think maybe called the HEROES Act or the CARES Act. I'm not sure which one it was, but the point being is that until October, where the next fiscal year starts for U.S. federal, they need 60 votes, and that means they need 10 Republicans to sign on, assuming, again, all Democrats will sign on. And what I think this will continue to impact is it will continue to push commodities higher, especially for those that are being used here for whatever they're building. And with more fiscal deficit, because this is spending money, and you won't see it, if there is any benefits, you won't see it until later, because you spend money today and you build it, and you don't get any benefits from it until later. That will mean more monetary policy, because if you're not getting the money today, like in tax revenue or whatever, that means you're borrowing. And if the federal government is borrowing, well, as it stands, most of the money, like I think it's 60 cents per dollar, is being financed by the central bank, by the Federal Reserve. So that means more money printing. And the hopes will be to drive productivity to increase domestically. But again, infrastructure spending is cost for the present in hopes of cost saving or higher profits in the future. But my thinking is that the benefits would not outweigh the costs, especially when it's funded by borrowing at artificially low interest rates. And I don't think rates will stay this low forever. And because you're borrowing, you're at the added costs, I don't think it will outweigh it. So that's something to continue to observe, if they can actually improve productivity, or we're just spending more money on things that we could have gotten cheaper. Next up, let's take a look at the U.S. tech bubble. So recent earnings, some have been beating expectation, yet it's unable to push the index higher. So, for example, is Amazon. And what we can see from Amazon's earnings is that it was alright, but the key takeaway was that there's lack of investment, and I think that's kind of what's built into the stock price, where for future-wise, they're not looking too good in terms of the additional growth at these level, what is being priced in at these level. So the index is being supported by the observed valuation, the few indices, especially the Nasdaq, with real rates being historically low, and it's helping to drive a higher valuation with lower discount rate, and it helps support growth more than value. And eventually this last bubble in the Nasdaq will give, and US tech stocks has been the ones that are holding up the US equity bubble the most. And when either real rates rally, or when valuations have to come back to reality, either through earnings or more reports or more catalysts, and that's kind of what we're waiting for. It could be, like, especially with the FANGs, maybe more antitrust, maybe earnings not meeting the very high expectation, or lack of demand. Either consumers don't have as much money to spend anymore, like maybe we're not having as much stimulus money going forward, or because of the increased costs, some companies actually have to cut costs. And I think what they'll cut potentially is advertising. So if you imagine like Google and Facebook, where a lot of their money comes from advertising, if a lot of their customers, these companies, are trying to stomach this higher cost in their products by not passing it on to their customers or passing on less. If they're trying to cut costs, if they're cutting advertising costs, then that's negatively impacting these FANG stocks, especially with Facebook and Google. Next up, let's talk about China's deleveraging and also some other emerging markets like Turkey, Brazil, and Russia. But those countries have, well, not Russia, but Turkey and Brazil has been mostly doing it because of to try to slow down inflation, where China actually took a preemptive cut. Not so much on inflation. There was some in the real estate market, but not so much in terms of like a general basis. And the deleveraging continues, and that's what we've been seeing last week, where the equities market are breaking key levels. Like I mentioned before, a buying opportunity should emerge by like fourth quarter or even first quarter next year. So we're waiting for the deleveraging process to be over. Again, why is this happening right now is because with the overflowing liquidity from US, it's helping to support financial asset prices, even though there's been a lot of defaults in a lot of the Chinese equities. And as we continue, meaning, yes, in the high yield market in China, the default rates are high, but investors, because of overflowing liquidity, are still willing to pay for those potentially defaulting debt, because the return is so much higher than if you were to go for a more safe US bond. So it's a different mindset where US is trying to pump up as much demand in the present at the cost of the future, bringing future demand to the present, and also not improving on productivity. There's not as much investment, but rather just consumption, where China is building more benefits for the future at the cost of present. So they're trying to establish a better capital structure, removing unproductive companies, letting them fail, not saving them, and better, more capitally supported companies will thrive once this whole process is over. Now let's take a look at some commodities updates. So if you take a look at commodities as a whole, they've been taking turns cooling off. Lumber has come off its crazy highs. Now I think it's about $700 from high of I think $1,200. Copper easing off a bit. Corn, soybean, etc. Well, we recently have coffee, sugar making new all-time highs. And this is because of a lot of, obviously there's the actual demand, but then there's also the financial engineering, where, for example, with corn and soybean, a lot of farmers seeing these historic prices, they went into the market, they sold a lot of long-term futures, where today they go into the farm, they increase the area that they're farming for corn and soybean, and they sell a future to deliver in a year or so. And what that's happening is a lot of these suppliers are able to sell these historically high futures because they know the price is absurd, and they're able to deliver in the future, and that's pushing down the prices, and that's kind of what's happening. Now the question is then, can demand pick up enough to continue to push these commodities prices back up? Now for precious metals, in the short term, there's the risk of tapering, or at least the market fear of it, and the Fed's pressure to stop or slow down China's deleveraging. Because what happens is, as the Fed is continuing its easy money policy, China is able to have an easy time to deleverage, to because, again, there's overflowing liquidity, so investors are willing to pay for defaulting China bonds. And so China financial assets are not falling as much as it otherwise would have. And so that is something that is not desirable to the US. So that is what's giving Fed pressure to stop their easy money policy. Another risk is liquidity crisis. With a lot of money going into repo market, and investors, like the more sophisticated ones, not as willing to buy these equities at these historic prices, and retail investors are going and taking on leverage to continue to try to bid up these prices. If there's a liquidity crisis, then there could be a big sell-off, and that is continue to be the short-term risk. Long-term, what can push precious metals is if the next liquidity crisis happen, or before that, the Fed preemptively can increase a lot more money supply, meaning they print a lot more money, to prevent the liquidity crisis, prevent a big sell-off. Then we can see, again, a lot more money being printed, a lot more inflation, and that could help push the precious metals. Again, short-term risk. Long-term, there's still I'm expecting the Fed to not let everything crash, and so therefore, or even if it has a big correction, they'll come in right away. Because if they were willing to do the right thing, they would have done so already. Like, they had an opportunity this whole time to just let these absurd financial asset prices fall, but they haven't been able. They haven't been willing to. They chose to kick the can down the road, continue money printing, propping up these prices. And finally, there's also the lack of capital investing in mining, where the number of new mines have. So this really is this is more so on the supply side, where there's not as much new mines being developed, and so that is also what could help. And as of right now, what I'm seeing is the mid tiers is quite cheap compared. Like, if you take a look at gold, it's not at its 52-week low, meaning like a year, but the mid tiers are really near their 52-week low. So meaning, even though precious metals are not in their 1-year low, but investors of miners are unwilling to believe that precious metals prices will stay at these prices, like especially with gold. And that's why I think the mid tiers right now are considered cheap, based on assuming that current prices will continue either higher or at least just stay the same. Finally, let's take a look at oil and uranium. So oil, OPEC Plus had a little drama where one member tried to say, "Oh, I'm gonna quit. I'm gonna increase production. Screw you guys." Obviously, it for the benefit of everyone. A cartel is not to be broken up, and so they've agreed to increase production. That should help with the shortage issue at the moment. COVID-19 variants, Delta being a very crazy one, that might slow down more reopening, more people flying. That's going to have an impact on the demand side. Long-term prospects still looks attractive, given the lack of capital investment for years, U.S. shale mainly, where a lot of people got burned by investing money in U.S. Oil, and also with the new administration pushing for less U.S. oil, so U.S. turning from a oil exporter to an oil importer. That's going to have a huge impact on the supply picture. And currently, right now, mid-cap Canadian equities looks fairly cheap at these current oil prices, where assuming oil prices either slightly increase or even just stay the same, the mid-cap equities are providing good dividend yields based on, again, investors are unwilling to buy these equities because they don't think that the oil prices will stay at these levels. And so my thinking is, $70 is probably the floor. And at this price point, a lot of these equities have pretty good cash flow. And I think we'll see that being reflected if we see a few more quarters of the oil price being above that level, and also we see more earnings report and seeing the cash flow that comes in for them. Finally, let's take a look at uranium. So Sprott announcing physical uranium trusts. This, like ETF, this should help with pulling supply off the market. Again, China continues to work with Russia on nuclear energy development, like they're sharing technology. And the recent decarbon movement has actually brought, I was actually surprised by this. I didn't think people now would be open to nuclear as much as the attention has brought in. But the movement has brought in more exposure and good sentiment towards nuclear energy. So possibly this can push for more, some politicians' political agenda, or maybe we'll just have more development into it. Again, the Japan restart remains to be the short-term key, and that depends on the political picture where, a lot of people in Japan domestically is still concerned about it. And so until Japan restart, that is going to, because they're one of the bigger users, that will be the big key. So right now at these levels, like $30 uranium, the juniors are extremely overvalued. They're pricing in much higher prices, like 60. But meaning they can fall by a lot. But a lot of these investors are being speculative with the uranium price. So if this is something that you believe in, in a few years, then I think this would be a good investment. But again, very risky until it all plays out, or at least we see more development. I would say just stick with the seniors, because they have for example, Cameco is being able to establish more long-term contract at much higher prices than these spot prices, because that's something that they mentioned they wouldn't restart their mines until long-term contracts, or until they're able to secure long-term contracts at much higher prices that they can return value to their shareholders. So that's what I would start until the picture looks better, or maybe a big claw down on the junior side before taking a more risky approach by buying the juniors. Finally, key takeaways: U.S. economic outlook. So lack of long-term productivity improvement, with both people not working as much. The older generation is taking an early retirement because of their increased value in both stock portfolio and also real estate. And the increase in GDP is from consumer spending, which I don't think would be can't last forever, because you're borrowing to do it, and there's no additional investment into productivity. So the overvalued U.S. equity market, led by tech and growth stocks, it's only a matter of time before they have to correct. And then the question is, what will the Fed do? Are they going to come in, print a lot of money, and try to support it again? And then once that happens, that will again speed up the money supply, and that will be a good picture for commodities. The Fed's inability and unwillingness to taper, as Powell continuously to talk down like, hey, it's not happening, don't worry about it, and a lot of people are questioning, like, if he's saying that the economy is so good, how come we're not tapering right now? The truth is that the financial market is actually very weak because of the artificially low interest rates and the Fed easy monetary policy that asset prices are at these levels. And if Powell and the Fed is to take that away, then the financial prices will fall. Emerging market deleveraging, unlike financial crisis before, emerging markets are learning their lesson. They're getting ahead of the curve, ahead of US and the Fed by deleveraging before US and Europe, and to avoid a bigger crisis later on. They're popping their own financial asset bubbles before the Fed finally taper, shrink their balance sheet, and pull liquidity away from their markets, causing their markets to drop more. So if they're able to cause it to pop now, it's a smaller fall. And again, the final question is, what will central banks do in the next crisis? And that will determine what happens to financial asset prices and also commodities.